Welcome to Talk Tickers, the deep dive designed to filter the noise from professional earnings calls and deliver the insights you actually need.
Hey there.
Today, we're focused on a really interesting one, a company that sits, right on that fault line between traditional finance and the whole decentralized economy.
That's right. We're breaking down the Fold Holdings call. Ticker is FLD. This was their Q3 2025 earnings, which dropped on November 10th, right after the market closed.
And this is a company that calls itself a Bitcoin-first operating company.
Exactly. Their whole goal is to turn every single dollar you spend into sats, which, is the smallest unit of Bitcoin, by building BTC rewards right into the card and banking rails we all already use.
A very compelling mission.
Yeah.
But the third quarter results immediately gave investors a very mixed picture.
It was a classic tale of two reports.
Yeah, when the numbers dropped, you saw this clear earnings beat, which on its own would suggest a ton of momentum, but it was completely overshadowed by a really noticeable revenue miss.
Okay, let's just run the tape on those headline financials. On the bottom line, Fold delivered GAAP EPS of 1 cent.
A penny.
A penny. That translates to a net income of about $0.6 million. And that figure, it just crushed what the street was expecting. Everyone was modeling a loss.
Right, something in the negative 18 to negative 12 cent range. So a first-time GAAP profit is, it's huge news.
It is. But that excitement kind of faded pretty quickly when people looked at the top line.
Mm-hmm.
Revenue for Q3 came in at $7.4 million.
Which is still good growth, right? 41% year over year.
It is solid growth, absolutely. But it missed the consensus estimates, which were, targeting closer to 9.2 or 9.3 million.
So that's a shortfall of about 20%. And that definitely explains the initial caution from investors.
For sure. And if we look at a proxy for sort of operational health-adjusted EBITDA loss, that came in at negative 9 cents a share, a loss of about $4.2 million.
Okay, and how does that compare?
The good news there is that management held the line. That loss figure was basically flat year over year. So it shows they're managing the losses even while they're scaling up their volume.
And scaling volume is really the key phrase there. The underlying metrics show the user base is incredibly active.
Okay.
Total transaction volume hit $235 million. That's up 43% from last year. And if you look at the year-to-date numbers, revenue's up 48%, and that transaction volume has shot up 74%.
To $753 million. That velocity of spending, it just shows the product market fit is really strong. People are using this thing.
Okay, but here's where we start the deep dive. We have to unpack that $2.6 million GAAP profit because it is absolutely not what it seems on the surface.
Not at all. That huge swing to profitability from a $62.3 million loss in Q3 of last year, it was almost entirely non-operational.
So they didn't actually make money from their core business this quarter?
Basically, no. They made money because the price of Bitcoin went up and they cleared an old accounting liability off the books.
Can you break down those two pieces for us? Because the numbers sound a little technical.
Absolutely. So factor one was a $10.2 million increase in the fair value of their Bitcoin treasury. This is just a paper gain. The BTC they already held went up in value, and accounting rules say they have to report that.
Got it.
Factor two, and this is the really big one, was the absence of a $58.9 million charge. This is the fair value charge related to some old safe notes they had to recognize in the prior year.
So if I'm hearing this right, the profit they reported was just it was favorable crypto prices plus a one-time clearing of a huge debt liability from last year's balance sheet.
You've got it. It was a mechanical win, not an operational one.
Right.
That said, management seems very focused on the operational side of things. OPEX did rise to $13.3 million, up from about 9.4 a year ago.
Which you'd expect, right? Public company costs, higher volume.
Sure, but they were quick to point out they were actively managing costs. They actually cut their operating costs by nearly 10% just from Q2 to Q3 of this year. So they're tightening the screws while the volume surges.
Okay, let's pivot now to their core strategic asset, which is really the balance sheet and that Bitcoin treasury strategy. They're not just another fintech.
No, they're a BTC holding company with a product layer built on top. The treasury is the foundation. As of early November, they held 1,526 BTC.
And that's valued at roughly?
For approximately $154 million. And what's really crucial here is that's a 53% increase in their holdings since they went public. And management reiterated on the call, they have never sold any Bitcoin since their listing.
Okay, but that raises a huge question. If they're not selling BTC and they're still running at an adjusted EBITDA loss, how are they funding all this rapid growth?
It's a delicate balance. And they've set up a capital strategy that gives them optionality without, immediate dilution. They just secured a new $45 million revolving credit facility from a company called 2 Prime. And they have an existing $250 million equity purchase facility, an ELOC.
Can you just quickly explain what an ELOC is, the equity line of credit? Why would management want that?
Sure. The ELOC is basically a prearranged deal where Fold can sell shares up to that $250 million limit. The key advantage is control. Management gets to pick the timing and the share price.
So they're not forced into a big capital raise at a bad price.
Exactly. They could tap it when they feel the stock price is fair, which minimizes dilution when the stock is, depressed.
So Fold is essentially using these credit lines, the revolver and the ELOC, like an ATM card, to pay for growth.
Well, that's a good way to put it.
And they're doing it without having to sell the Bitcoin itself, though I see that funds from that new revolver are collateralized by Bitcoin from the treasury.
And that's the ultimate tightrope walk. They're preserving the BTC for future appreciation, but they're leveraging that same asset to pay the bills to build the business. If Bitcoin's price drops sharply, that would obviously put a lot of pressure on those collateralized lines.
Okay, let's shift gears to that adoption engine, the actual product execution. Management stressed 2 core growth levers on the call. The first is the one everyone's waiting for, the Bitcoin Rewards credit card.
This is their big catalyst for 2026. They've formalized partnerships with Visa and Stripe, which is a massive logistical hurdle to clear. It confirms they can operate inside those traditional card rails.
And the card itself sounds pretty compelling, up to 3.5% back in BTC rewards.
Yeah, and the demand is clearly there. The waitlist is now over 80,000 users.
So what's the big takeaway from that waitlist number?
The main thing is how efficient their acquisition is. Management confirmed that the vast majority of those 80,000 plus people are net new customers. They're not just existing Fold users signing up for something new.
So the idea of Bitcoin Rewards is pulling in a whole new audience.
It's expanding their total addressable market beyond the crypto native crowd. And they're targeting general access for the card in Q1 2026. And they are absolutely banking on that being a major inflection point for next year.
Okay, now let's talk about the second lever, which is maybe even more interesting, the Bitcoin gift card. It's already live and scaling.
And it's remarkably clever. The gift card is available in about 2,000 Kroger branded stores, online, and through promos, like one they have with Steak and Shake.
Right, you get some BTC with your meal.
Yep. And the company loves this channel because they called it a negative CAC distribution channel.
Negative customer acquisition cost. That sounds almost revolutionary for a fintech.
It is strategic genius. They make revenue when the gift card is sold at the store. Then, when the user redeems it in the Fold app, they've just acquired a new user for their ecosystem. They're literally getting paid to acquire customers.
That sounds amazing, but I have to be a little skeptical. Management said 80% of all gift card sales happen in November and December.
Seasonality?
Right. So if that volume is so seasonal, does that negative CAC metric really hold up for the other 9 months of the year? Or do their acquisition costs just skyrocket from January to October?
That's the perfect question, and is the operational risk they face. They have to prove that this gift card channel is durable beyond the holiday rush. But for right now, it means this channel will be absolutely critical for the Q4 results we're in now.
Which brings us back to their user base. They've got over 625,000 active accounts, but only about 82,000 of those are fully verified. That's a huge gap.
And that gap is the entire strategic point of the credit card. Management sees that card as the key to unlocking that huge base of unverified users and turning them into power users.
So moving them from someone who just pops in for a reward to someone who uses Fold for everything.
Exactly. Capturing 100% of that household spend. That's the goal.
Okay, now that we've covered the financials in the product, let's zoom out a bit and put these results in the current investor context, starting with the macro environment.
And the environment is brutal right now, especially for these BTC-linked stocks. Fold stock has had a really severe one-year drawdown. It's down around 71%, which is much, much steeper than a pure BTC beta proxy, which is only down about 5% in the same period. And, Bitcoin itself has been under pressure, down about 28% since early October. That's a headwind for everyone with a big BTC treasury.
And if we look at the valuation, the numbers are almost comical.
They really are.
The current market cap is about $145 million, and we just said their Bitcoin holdings alone are worth approximately $154 million.
And that is the most fascinating nugget from this entire call. The market cap is actually less than the value of the Bitcoin sitting on their balance sheet. The implied market NAV is only about 1.1 times the value of the Bitcoin stack.
So what does that imply about market skepticism? I mean, a pure holding company would trade at 1x NAV.
Right.
Fold has a high-growth fintech operation, 625,000 users, that huge waitlist, and a negative CAC model. And the market is only assigning a tiny 10% premium to all of that.
It implies the market is deeply skeptical of their operational costs. They're effectively saying, we will pay you for the Bitcoin you hold, but we're assigning very little, maybe even a negative value, to the ongoing losses required to run the actual business.
So the market needs proof that the operating layer can get to scale and profitability before they'll assign a real growth multiple.
That's it. But despite that skepticism, management is still guiding for a 50% year-over-year revenue growth trajectory, even without formal 2026 guidance.
And what do the analysts think?
Sentiment is still overwhelmingly positive. The consensus is a strong buy, with an average 12-month price target around $7.80.
Which is, what, about 160% implied upside from here?
Roughly, yeah. And that confidence is really based on the protection from the BTC treasury and, the huge potential of that credit card launch.
So the core risk is just execution. They have to nail the card launch in Q1 and show that the new volume can start to close that EBITDA loss gap.
All while navigating the crypto volatility. No small task.
We have now reached the segment of our deep dive we call Not Financial Advice, where we shed our impartial analyst hats and pitch a high-conviction, outrageous, but plausible trade idea based strictly on the nuances of this earnings call.
Okay, the thesis here starts and ends with that valuation anomaly we just talked about. Fold is priced like a leveraged Bitcoin proxy, trading at only 1.1 times its BTC holdings. That's just cheap.
So the market is ignoring the operating business.
Completely ignoring the 80K waitlist, the negative CAC channel, all of it.
Yeah.
If that Q1 2026 credit card launch executes flawlessly, the whole narrative shifts overnight from a depressed treasury stock to a real differentiated consumer finance company.
Okay, so we're betting on the credit card launch being the catalyst that unlocks that growth multiple. What's the trade structure?
We go long FLD shares. We're targeting that consensus price target of $7.80. And specifically, we're aiming to capitalize on the period before the general access launch in Q1. Buying into the anticipation and the early data confirm the rollout is working.
And since we know macro volatility is the biggest headwind right now, how do we neutralize that systemic risk?
We hedge it out entirely. We would simultaneously short a pure Bitcoin ETF proxy, something like BITO or IBIT, in proportion to the company's beta.
Okay, so the hedge makes it a pure play on the company's execution.
Precisely. Our long position then only benefits from company-specific execution and the closing of that valuation gap. We're betting on Fold's management, not on the spot price of Bitcoin over the next few months.
All right, let's wrap this up.
To summarize our deep dive into Fold holdings, Q3 2025 delivered their first ever GAAP profit, though it was, mostly driven by a paper gain on their treasury. Operationally, they showed impressive volume growth and validated some really efficient acquisition channels.
Like that negative TAC gift card.
Exactly. And the strategy remains clear. Use the strong treasury as leverage to fund new products like the credit card that are designed to capture 100% of a user's household spend.
What stands out to me is the metric management cited as their number one focus for the treasury's success. SATs per share. Satoshi per share. They are purely focused on compounding the smallest unit of Bitcoin for their investors. So this raises an important question for you, the investor, as you analyze this. Will the market ultimately shift its focus away from these quarterly revenue misses and EBITDA losses and start valuing the company on its ability to compound SATs?
Or do they have to prove sustained operational profitability first before they earn that growth multiple?
That tension, the operational loss versus the compounding treasury, is the whole story here.
It absolutely is.
Yeah.
And it's what will determine the stock's future.
Something to mull over as we head into this highly seasonal, highly anticipated Q4. Thanks for joining us for this deep dive, and we encourage you to continue your research into this really unique intersection of finance and crypto.